Monetary policy is at an inflection point. That's the word from the Reserve Bank Governor Shaktikanta Das. The central bank has just released the minutes of the last policy meeting of December 8, and it shows that all 6 members are worried about growth and about inflation. RBI Governor's statement itself went on to say that global policy unwinding may have spillover effects on India, and monetary policy is going to get very challenging, to say the least. Well, we are now joined by the external members of the Monetary Policy Committee. I'm joined by Professor Ashima Goyal, Dr. Shashanka Bhide, and Professor Jayanth Varma. Gentlemen and Ashima, thank you very much for joining us on the show. Dr. Varma, let me start with you, since you are the one member who's dissenting about the stance. You wanted the short-term rates to rise. You don't have a quarrel with repo rate itself remaining at 4%. The Reserve Bank, since December 8th and even before, has been doing a lot on the liquidity front, moving money from the fixed rate 3.35% towards the variable rate reverse repo, which is almost 4%, 3.99. Would it satisfy you if the interbank call rate moved up without the Reserve Bank touching the stance?
No, I think there are two issues here. Either you say that the reverse repo rate is important, or you say that it is not important. Okay. Now, if you say that it is important, then the thing is, why is it at 335? Okay, which is clearly a wrong level at which it should be. Now, if you say that it is unimportant, then I think you are in even more dangerous territory. You're asking what happened to the entire corridor system on which we run our monetary policy. So if you believe that the corridor is important, both as an operational measure and in terms of the communication and the symbolism of the corridor, then it is very important that the corridor be set at the right point. And I think 335 is clearly wrong. I don't think anybody thinks 335 is right.
Okay.
So, I really don't understand why there is hesitation about moving 335. You want to, do everything except change 335.
Okay.
And 335 still impacts some things. As you rightly pointed out, the weighted average call rate is close to 335.
Yeah.
Also, I think there is a question about the stance. I think we are at the point where risks are clearly balanced. If Omicron proves to be, just a minor blip, then clearly monetary policy is too easy at this point of time. On the other hand, if it proves to be much more serious, then monetary policy might need to go in the opposite direction. So I see risks as being very well balanced at this point. And that is the point where the stance has to be neutral. I don't know what the data is going to tell tomorrow. And I should be prepared to tighten, I should be prepared to ease. Therefore, monetary policy ought to be neutral today. Okay. Those are the two big issues as I see them in my dissent.
Fair point, sir. I think almost everyone will agree about the 3.35 part. Maybe it is difficult to justify a 65 basis point corridor between repo and reverse repo. It was justifiable in March 2020. Is it justifiable in December 2021 is a question everyone has been asking. And in our pre-policy poll, quite a few people did expect either a reverse repo hike or at least a timetable for a reverse repo hike. Ashima Goyal, you are also veering around to the point that it is right of the Reserve Bank to use the liquidity tool. And you are even going on to say that durable liquidity should be reduced. If you agree to so much, you would also agree that the time is nigh for a reverse repo hike? I mean, it's like round the corner, you would think?
Well, you don't really need it because the average reverse repo is really near the repo rate now.
Okay.
In exceptional times, when exceptional durable liquidity has been injected, the LAF can't function the way it used to earlier. because there's still so much durable liquidity that you would be paying much more at a higher fixed reverse repo. And yet the durable liquidity, you would be giving more arbitrage opportunities to banks. While this way you're using a market-friendly approach to reduce liquidity available and giving market-determined rates.
Okay.
Yeah?
Yes. We are, but the market is still determining some rates at 3.35. For a day after the Reserve Bank announced the 3-day variable rate reverse repo, the call rate did go up to 3.8, then came to 3.5, and has today closed at 3.35 again. So, there seems to be a limit to the liquidity moves, and maybe... Yes.
The reason to deal with that is to reduce durable liquidity.
Yes. Okay. Well, I would assume that is round the corner, but yes, that is the suggestion that you are giving. Dr. Bide, while all the other members like you are apprehensive about growth as well and don't believe that recovery can be taken for granted, you are clearly not showing so much worry about inflation. Isn't there a fear with WPI at 14.25 that things can get a bit entrenched, as Dr. Varma says? Continuously closer to the upper band can be a danger. You don't see that at all?
Obviously, I guess inflation is a concern. And, I guess the core inflation being what it is, it certainly is a concern. But I think the issue is how much of that is from the demand side pressure and how much of that is actually supply side concerns.
Yes.
And so I think that is where I suppose there can be some differences in the way we see this situation. So I think the fact that energy prices, for example, fuels, they rose by a very significant rate over during this year, actually. And therefore, I think the concern is how much of this can be fixed using demand side tools and what can be done to reduce the supply side, either the bottlenecks or the constraints.
Okay. That's a fair point. And I think Mridul Sagar also veers around to the view that